first thank our sponsors. We wouldn't be doing these programs without the support which we've had from the start from Greg Keegan and Ken Greeny of JP Morgan. Greg and Ken, I saw Greg. Greg's over here. So see Greg regarding your portfolio needs, please, by all means. David Brown of Red Hawk Associates is the sponsor, and of course he's been with us from the start. This was his idea. Mike Maimoni has handled our website for the last year, and that'll be transitioning. You'll learn more about that later. Wyndham over here to my right has been a new addition. This is Wyndham's third meeting, and Wyndham is with Creative Gold Media, and he does the videos. And so we have new features for the videos today, and you can watch, but more importantly, the 800 people on our list who aren't here today can watch the presentations on YouTube after the fact. We've started this year for the first time two networking events. And those are going to be both at Chuck's Beverage. One's going to be in October and one's going to be in February, and they'll be on the third Thursday of the month. And finally, we're going to look to bring on some additional sponsors for this group to drive it to a higher level. More functions, probably in the ideal world we wouldn't charge for the networking events, and then we want to share the information that we're generating. We want to share that content more widely. So people that are interested in exploring the sponsorship opportunities, which are limited, we don't envision having dozens of sponsors. People who are interested in exploring that possibility are encouraged to contact my son Bradley either after the meeting or at a later time. Let me, with no further delay, introduce David Brown, who will be the Master of Ceremonies of today's program, the host. Thank you, David.
First of all, welcome everybody, and welcome Dan Kessler. Mr. Kessler joined Cyprium Partners from Key Principal Partners. Prior to KPP, he was with Global Streams Inc., a developer of streaming media management software, where he served as vice president. Previously, Mr. Kessler spent 5 years with PricewaterhouseCoopers, most recently as a manager in the M&A transaction group, where he managed project teams conducting financial and operational due diligence, great background in post-acquisition integration consulting. Dan received his BS in accounting from Indiana University, his MBA from the University of Chicago, and is a CPA. He works and is a partner at Cyprium Partners, which now is investing its fifth fund, has invested $1.5 billion in 86 companies since 1998. Their target criteria is EBITDA of greater than 8 million, and you feel free to correct me.
That's right.
Invest between 10 and 60 million in each deal. And they look at manufacturing, distribution, healthcare, and business services. Apparently you shy away from real estate, I think.
Correct. No real estate, no heavy natural resources. Okay. The rest of the world is open to us.
Okay. So let's jump right into it, and let me really encourage questions. Anywhere you guys want to take the conversation today is great. We've got some scholars over there from Walsh University in Akron. We've got deal meisters like Rick and Mark Leisman, and incredible CEOs and COOs like Remo and Tom in the back. So let's just really go for it.
This really is an incredibly diverse group of advisors, business owners, operators, farmers, which was unexpected and wonderful. And so it's a great organization you all have put together, and really pleased to be up here talking with you this morning.
Oh, great. So we're glad you're here. So let's just jump into it, and we'll kind of meander around our questions.
Good.
But you and I were talking before we got started a little bit about the circumstances under which Cindy is not here. So that kind of gives a snippet or a glimpse into the type of work that you do, the type of opportunities you're looking for. So could you just give a little background?
Yeah, happy to. So Cyprium is a private equity fund. However, unlike 98% of the private equity world, we're focused on making non-control investments in family, founder, and entrepreneur-owned businesses. So whereas the many wonderful Cleveland-based and worldwide private equity funds that most of you know and have heard the names of go out and acquire businesses. That's not what we do. We instead make these illiquid, longish-term, non-controlling investments in support of businesses. Most often there is not a change of control. And so that leads to what Cindy is doing. She is at the kickoff, due diligence kickoff for a new investment opportunity that we signed up earlier in the week, or I suppose late last week. And in that transaction, we're providing subordinated debt and preferred equity to a family-owned business to support their growth, as well as provide a dividend to some of the shareholders. And those are two of the common things that our capital is used for. And so if you think of the four buckets that are non-control capital, which could either be junior debt, so subordinated debt, we don't do any senior debt, could be subordinated debt all the way through preferred or common equity. The four buckets most typically are growth capital. So in this case, the company has grown very rapidly, would like to continue doing so, has a lot of opportunity both with existing and new customers, would like to build a new facility, so we're providing financing for that as well. A shareholder dividend, which is another thing that we typically provide capital for. In this market, what we're seeing a lot of is opportunities where there's a disparate group of shareholders. Some want to exit and some want to stay in the business. And so we can provide that non-control capital to allow the remaining shareholders to continue owning and running their business while cashing out those that wish to exit. So shareholder dividends would be the second bucket. The third is refinancing. There will be a senior refinancing likely as part of many of our transactions. We work with typically commercial lenders, banks, rather than finance companies and rather than credit funds. We're looking for more relationship-oriented lenders. And so many of the banks that you see around town, Huntington's, Chase, BMO Harris, Bank of America, all the types of organizations that we have as senior lenders in most of our deals. And then I guess that's the buckets.
So here's my question, or a question. I think you said typically that you're acquiring family-owned businesses, and by taking a minority interest, I would guess that typically the family stays in and they continue to operate the business. First question is, how do you address some of the issues involved with that? You know, you're the outsiders, you're from Cleveland. In this case, I think this company is on the West Coast. So you're strangers, you're not part of their culture. Give us a little, insight.
So we are generalists. We're not specialists in any given industry. In this case, it's a beverage-oriented manufacturer. So we do have experience in that space. We've invested in the second largest private label bottled water company in North America. We invested in Aseptic, which is a shelf-stable beverage producer. So we have some industry understanding there that helps. But getting into these situations with family-owned businesses, there are some days where I'm not really an investor. I'm a family counselor. I'm helping sort out whatever the issue is between two brothers running a business, or between a group of cousins, or if it's not family and it's 3 or 4 or 5 shareholders, maybe a management team. We try to be that impartial party that can come in and we hope to challenge them in a helpful way and not in a destructive way, certainly. But a lot of these family-owned businesses, the owners and the family members that work there have only ever worked there. And so they really welcome us as an outside viewpoint. But we spend an awful lot of time prior to making our investments really understanding the business, of course, but also understanding those individuals. In contrast to a control-oriented private equity firm, where if you don't like the VP of sales, you get a different one. For us, we don't have that ability. And so we really need to do our diligence and buy into the strategy that is in place and understand what the owners and management team of that business really want to accomplish and how they're going to accomplish that. Because more often than not, in a family-owned business, the CEO is also the majority owner, and his or her name is on the outside of the building. And so if somebody's going to go, we're going to be the ones that go, not that business owner.
So again, encourage questions. I'll keep after it. So in a typical situation, Dan, how do you not really protect your position, but how do you get involved in the governance of the company? Is there a board of directors, and do you guys have seats on that board?
We do. In virtually 100% of our companies, we do serve on the board of the companies. Oftentimes, we're helping a family-owned business to create a board for the first time, or an entrepreneur-owned business to create a board of directors for the first time. And sometimes it's companies that have a very well-established board. We work with a company in the Pacific Northwest, family-owned by two individuals, and they have a board of advisors with some very senior level people from their industry. And so in that case, it's fairly plug and play. We just come in. But in most of our opportunities, there is not a real board established. And so we're helping them understand how that board meeting that we have quarterly can be useful to them, rather than just a distraction that, oh, here comes the investors in 4 times a year to bust my chops about something.
Right.
Instead, it's, hey, here come the investors. I don't know anything about hedging interest rates. Well, Cyprium does. We can help explain that. Or I don't know anything about setting up an operation in Mexico. Cyprium does. We can help with that. And so we try and keep it helpful and targeted for those management teams. But of course, we have ongoing conversations with CEOs and CFOs of our companies between the board meetings as well.
So you have, I think, in the portfolio now 6 or 7 different businesses. Do you expose, say, this target business, and once you complete the acquisition, do you expose them to maybe a couple of your other businesses, just so they can see, hey, this is how it works, and
we
don't
do.
be intimidated, here's what to expect?
Yeah, so we like to say that our references are our best opportunity. So we're in a very relationship-oriented industry, particularly as non-control investors. And so the sooner we can present our references to a business owner, the better. And oftentimes, just out of those reference calls, they strike up relationships. Oh, the owner of this beverage company may call a reference from one of our other beverage companies. Oh, well, what equipment are you running? And now they've got a relationship. As well, once a year, each June, we have an annual meeting, and 1 or more senior executives from each of our companies will come in. And we typically start with a CEO or an executive session the day before the meetings, and really network and try and bring in some sort of topic that is relevant to the broader group of executives. So for example, this past June we had a firm come in and talk about Microsoft BI and Tableau, and how to use some of these visualization tools, data visualization tools, to really improve their business, to help them with their management of their business. And for a few of our businesses, they're already doing some of this, and they can be the thought leaders in the group. But for a lot of our businesses, this is new thinking to them, and they're not otherwise exposed to some of these things. So we start with that executive session. All of our limited partners come in the next day. Each of our CEOs or CFOs does a brief presentation to the full group, and we learn about the businesses together. And so the relationships that are built at that annual meeting, we encourage to extend beyond. And so we frequently see this peer network establish amongst the executives of our companies. As well, we have an advisory council of 6 former and current executives that we can loan out or help loan to our portfolio companies to help them with specific issues. So if you want to run a strategy session and you're $50, $60, $70 million business that doesn't have a lot of experience thinking about the big picture, maybe you're focused more on the tactical, one of our advisory council members can come in and help with that. So we really try to add value where we can, even though we're in this non-controlling role.
Good. I want to come back to that kind of secret sauce, but there's a young man in the back. Yes, sir.
Perfect. Can you tell us a little bit about your organization, how many people you have, where they're located, how many dollars in your fund, and how much maybe you typically invest in each project?
Sure. So Cyprium was started in 1998 by a gentleman named John Sonnenberg, who is still one of my partners today. So there are 6 partners in our firm, 4 are in Cleveland, including Cindy, who is not here, and 2 in New York. Our third office is in Chicago. There's just 1 person in Chicago. So we have, across the various positions, about a dozen investment professionals and then a small back office staff that all reside here in Cleveland. And we're investing anywhere from $10 to $40 million in each of our portfolio companies. That can either be a $30 million upfront investment, and that's it, or it could be 20 upfront, another 10, another 5. So through add-ons, that can often grow. For larger opportunities, for example, the opportunity Cindy is working on right now happens to be larger than we would hold in our fund. And so we bring in some of our limited partners who have an almost insatiable appetite for co-invest. So we'll bring them into our deals if it gets much larger than 40 million.
Would the LPs be family offices, or would they be high net worth individuals like Remo, or?
Yeah, so it's a variety. So it's family offices. There are a few pensions. But the biggest base of our limited partners are insurance companies.
Oh, okay.
Because over time, about 2/3 to 3/4 of the securities we invest in have a current pay component. So it's subordinated debt or preferred stock with a current pay. So that's very attractive to the insurance companies, and then they get the boost from the equity component.
Okay. Just going back to the work that Cindy did this week, or you would do if it was a new investment, you're kicking off due diligence. How do you, or do you go after and do you approach, surveying management or understanding management and their capabilities and possible weaknesses any differently than you would if you had a control position? And if so, how do you think about that?
Yeah, we do. As I said earlier, if you have a control position and you don't like an executive, you change that executive. For us, we try to understand these individuals that are running the company, not just from a business perspective, but also a personal perspective. Right. So we want to have dinner with them. We want to spend more social time with them prior to the investment, have more meetings on the business side as well, because we want to see what is most important to them, both from a business sense and from a personal standpoint. And so we do, particularly in a family-owned business, we'll probe a little bit more around the family relationships just to see how functional or not those are. And we found over time that business owners are really pretty upfront with us about what is and what is not functional in their organizations, to the extent they know it. Now, there are obviously cases, we've made 87 now investments in privately held companies, and there are of course cases where we get in and it's not exactly as advertised. And as a non-control investor, you have to work your way through that. And you have to be open and honest and say, hey, look guys, the way you're running the company is not what we thought we were signing up for early on. Let's part as friends, but it's time for us to part company. And those are sometimes difficult conversations to have. But we talk to business owners in the initial meeting we have with them, we would rather, if we're not going to make a connection with you, we'd rather you take capital from somewhere else. The capital is the commodity, the relationships are what's important. And so if we aren't the best relationship for you, go somewhere else. We hope we can become the best relationship, and we strive to do that, and we work as a team to match up the team on our side with the needs of that company and that management team. But there invariably are opportunities where we love the business, but for whatever reason we just didn't click with that management team, and we'd rather have a no for the right reason than a yes for the wrong reason.
Sean?
So Dan, you had mentioned some commodity nature of your product. What have you seen with expected returns over the years, and what sort of trends do you foresee?
Is that a loaded question, Sean? So Sean and I used to work together many moons ago. So yeah, certainly over the I've been with Cyprium for 18 years and around private equity in general for about 25. And certainly over time, returns have come down. There's so much more competition now than there was even 10 years ago. And 10 years ago, we thought there was a lot of competition. Now, in particular for us, the growth in credit funds and unregulated capital has changed the dynamic for us. There's a range of what are referred to as unitranche providers who can provide the full debt suite through subordinated debt. And so we find ourselves teaming up with the commercial lenders who are providing the senior. We'll provide the sub-debt, maybe preferred, to compete against that. And so definitely returns have come down over the last 10 years. I don't think they've come down appreciably over the last couple of years, at least in our non-control niche of the world. Our pricing is our pricing is generally going to be a little bit higher than you will see in the sponsor-oriented sub-debt market. And same thing with preferred. And we'll structure our deals a little more conservatively than a traditional sponsor-owned business, because there aren't those deep pockets at the table to inject capital if you should need it. Oftentimes we're looked at as the deep pockets to inject that capital, even though we're in a non-control role. And so sub-debt pricing on a sponsor deal is going to be 10-11%. On a sponsorless deal is going to be 12 to 14%, and equity on up. I think our limited partners in general for the alternatives assets classes have become more realistic. You see some of the large pension funds adjusting down their expected rate of return. I would say a lot of them are still very aspirational, but they're getting better.
So would that 12 to 14% be essentially the coupon, and then in addition to that would be any conversion, the value of any conversion rights? Okay, so.
Yeah, so we have a lot of flexibility in how we structure our investments, whether it's sub-debt or equity. And so sub-debt, we can have a higher coupon and lower or no warrants, or we can have a lower coupon and have some equity upside. Okay. So the most typical is something around a 12% coupon. Okay. That may have a couple of points of PIK and the rest in cash, okay, and then an equity kicker on it on the back end.
Yes.
How do you monetize your investments in a non-controlled situation, especially in a family environment that says, I like your money, but I'm never going to sell this business, and you got to compete with the rest of the marketplace, right, for your capital. So how do you force the situation to get the kind of returns that
sure,
the market says you should get?
Yeah, so the question is, how do we exit our investments if it's a non-controlling investment and we don't have the right to sell the company because we don't control it? And so on a debt investment, there's a stated maturity, and at the end of the term, they're obligated to refinance our debt. On an equity security, which I think is really what you're getting at, we do have contractual rights to put our shares back to the company at some point certain down the road. Mm-hmm. What happens more often than not, and that's 7-8 years down the road, typically. What happens more often than not, however, is we get 3 or 4 years into an investment and the company's done well, they've delevered, they look at us and say, you've been a great partner, we love you, you're bloody expensive, we're taking you out. Mm-hmm. And they generally have the right to do that. And so it'll be a negotiated exit. In about a third of our investments, our exit is through a sale of the company, but that sale is not driven by us, it's driven by the majority owner. And so these put and call rights that exist in our documents, they're there. It's pretty seldom that we actually go by the letter of the documents.
Yes, sir.
Do you mind sharing your hurdle rate?
Our fund hurdle rate?
Yeah.
Actually, I normally would. However, we're a registered investment advisor and we're in the process of fundraising, so I can't talk about the specifics of the fund other than to say that it's the normal hurdle rate you would see on a traditional buyout fund as well.
Yes.
Just some general thoughts on Northeast Ohio from Cyprium's perspective. Are there industries that are more appealing? Are there industries that are not as appealing right now, just from your perspective?
Yeah, so we're a nationwide and in fact all of North America practice. We've made investments, coast to coast, including Hawaii, throughout Canada. The interesting transition we've seen really over the last 10 years is the types of businesses that we're seeing. So 10, 20 years ago, it was a lot of businesses that were created in the 40s and 50s that were started by soldiers who came home from World War II and started a business. And there was a very, very strong emotional attachment to those businesses. What we're seeing, and we still see some of those, what we're seeing more often now, however, is businesses that were created in the 80s, 90s, 2000s, and the ownership of those businesses is viewed a little bit differently. And so Cleveland, in particular, has a nice mix of both of those. And so I can't really point to we're generalists, so I can't really point to specific industries that we're seeing more out of Cleveland than elsewhere. But other than to say that, you look around this room and hear, through the introductions where everyone's from, and it's a very nice cross-section of the economy. We have seen a lot of strength recently and a lot of opportunity in Detroit. Obviously, Detroit was very heavily hit by the recession, has now come back quite nicely. And so we are seeing a number of opportunities in the Detroit market across a variety of industries.
I thought I saw another question. Yes, sir.
How do you source transactions? Most private equity investors get it through investment banks or brokers, but I imagine you guys might be a little bit different because you're not looking at control investments.
Yeah, so the question was, how do we source our investments? So we look at about 300 opportunities a year, and of those 300, hope to close 4, 5, 6. Those 300 opportunities, about 2/3 of them come from investment bankers or intermediaries of some sort, business brokers, investment bankers. We don't see a lot of deal flow from the larger investment banks. Their processes are generally oriented towards private equity sponsors to begin with, rather than family-owned companies. And they're looking for a more efficient process than what we typically care to participate in. And so it's the investment banks that have 1, 2, 3 investment bankers all the way up to 20 or 30 where we see the bulk of our deal flow. The other third comes from senior lenders, which we see quite a lot of, executives, meetings like this where somebody will pull us aside and say, oh, hey, we're looking to make an acquisition. Let me talk to you about how you can provide capital. And so that third that isn't from investment bankers, those tend to be very unstructured types of transactions. What we see from investment bankers, they generally have some understanding of what they're looking for. What we tend to see a fair amount of each year is transactions where the business owner, the family or the entrepreneur, doesn't quite know what they want to do. They may want to sell a controlling stake, but only if the price is right and they have an emotional attachment to the business, so maybe not. And so we'll be invited into a change of control process by the investment banker, and oftentimes we're the only ones offering a non-control solution. And in fact, we have a investment under LOI right now that was that style. That they decided, you know what, we don't want to sell control. We want to take some chips off the table and make an acquisition instead. Those types of transactions typically come through investment bankers. We closed an investment earlier in the year called Arbor Contract Carpet. They provide carpet installation services to the multifamily housing industry in the southern states. And that was a case where it was a 70-year-old owner, 45-year-old CEO. The CEO owned a quarter of the business through a stock appreciation rights plan. And the 70-year-old owner said, I'm selling the business. Well, we worked with the investment banker. We're the only non-control alternative brought in to team up with that CEO and see if we could orchestrate a management buyout. At 45 years old, he's got a lot of business life left. And so helping him buy the company, and so today he owns a majority stake and we own a minority, but that's the type of transaction that we might see from investment bankers, even though it's a control-oriented sale.
Yes?
Could you tell us about the worst deal you've ever done, and maybe what were some of the defining characteristics or what you learned from it?
He's not allowed to talk about that.
Actually, they don't like me to talk about it, but I'm going to for you. Yeah, so the worst deal that we've done, I'm going to talk about one that I've personally done. And it was the worst deal from an emotional toll, not the worst deal from a financial standpoint. On paper, it looks like a fine transaction. But it was with and I'll not use names to protect the somewhat innocent. It was a transaction in which it was a family owner, an individual, and the business had been handed down from father to son, and he was a very sales-oriented CEO, and we thought we understood his plan going in, and there were some ethical lapses in the early days of the deal, and we kind of wrote it off to, well, he's still getting used to having a partner. And those lapses got larger and larger over time. And had the company been performing well, as I talked about earlier, not a big deal. We raise our hand and say, this just isn't what we signed up for. It's time for us to part ways. As we were discovering some of these ethical lapses, the company's performance was starting to go down as well. And so we had worked with the CEO, brought in a consultant to watch the piggy bank a little bit more closely. But it's a lot of sleepless nights trying to figure out how to exit an investment as a non-controlling, in this case, equity holder. Your documents give you a certain amount of rights, but you really don't want to go to court to enforce those rights. You really want to negotiate your way out. And so, as I said, it was a lot of sleepless nights trying to figure out, how am I going to look my partners in the eye and say, this is going to be okay? Because I don't know yet if it's going to be okay. And so, thankfully, we have a very open partnership, and the six of us are very frank with one another. And that one, the company's performance did turn around with our help. We had a supportive senior lender, and we were able to negotiate a partial sale of the business to a strategic.
So part of the topic today was in our last 18 minutes or so together, and I'm sure Dan, if you can, will stay around for a little bit for
happy
other
to.
questions and talk. Brent.
So are there good investment opportunities out there that are like hiding, where the business owners aren't even aware of options like you?
All the time. So we have two full-time business development folks, one in Chicago, one in New York, and they go to 50 markets across the country and tell the story of, here's how you can help your clients. They talk to mostly investment bankers and senior lenders. Here's how you can help your clients understand how to use non-control capital. So yeah, there are many, many opportunities out there that we just don't see. because investment bankers are really good at selling companies. Many of them just haven't had the exposure to these non-control alternatives. You know, it used to be a very binary world. If you're a family-owned business, you either owned 100% or you sold 100%. Now there's a variety of shades in between. And so it's a tremendous effort on the part of our firm and others like us to get that message out, that, hey, you don't have to sell 100% of your business. You can bring in sub-debt, you can bring in minority equity, you can get some liquidity, do intergenerational wealth transfer. You can look outside of the normal bounds of traditional private equity, whether it's us or credit funds, and accomplish some of these things. So when we're talking about where our deal flow comes from, of those 300 transactions and the 2/3 that comes from investment bankers, we're targeting those investment bankers that may see an opportunity that's right for us once every year, once every 2 years. It's just not we want to be that one phone call or 1 or 2 phone calls that they make when they see this non-control opportunity. There just aren't that many groups out there that do what we do with the consistency that we have done it for the last 21 years.
I think as an editorial comment, I like how you've differentiated yourself, and clearly there's a niche. Being on the other side in terms of selling businesses, you're generally, or I'm generally looking for kind of the fastest outcome, the most reliable outcome, which is a sale of 100% of the business, especially if it's a family business, because as you talked about earlier with the deal you're looking at on the West Coast, it's complicated to figure out how the family can retain control and bring in a minority investor and recapitalize the company. I mean, you figure if you're an investment banker, the way you get paid is through generating a fee, and the biggest fee typically is selling the entire business.
Right.
Got a little mountain to
Selling a
climb.
business is the easiest, generally the fastest,
Right.
and gets the investment banker paid the most. So yeah, it is a challenge. And so we have to work with as investment bankers to educate them on
Right.
when that business owner says, I don't want to sell, your next question should be, what might you need capital for that we can help you with? Do you want to make acquisitions? Does one of your shareholders want to exit and the rest stay in? How about a dividend or distribution? And so that is not, it's not an arrow that's in the quiver of most investment
Right.
bankers.
Oh, for sure. Yeah, Ben.
I was thinking this, usually if a company hires, I have clients that hire investment bankers, but normally when they're doing that, they've already decided they're going to sell a company. That's what they're thinking. So they don't go and hire Tom Zucker because they're thinking about raising a few additional cabbages. They're thinking about hiring Tom Zucker and others like that, Mark Philippou or something, or David Brown, because they want to sell the company. Now, I would think that many times companies that are looking to raise a little additional capital, maybe take some money off the table, I would think you'd normally find them, I'm not trying to give you marketing advice, but I think you'd find them, if they had a good relationship with either their accountant or their attorney. And I know most clients have to go to the accountant at least once a year, reluctantly. And some go to the attorney even less often. But those that have a good relationship with their attorney and accountant, they might know that they have a need for additional capital and want to explore it. But I would think when they get to Mark Philippou, it could be a little bit late to start.
Yeah, it just depends. So it's a great point. And we do spend a lot of time marketing to attorneys and accountants and other trusted business advisors, consultants. And in certain markets, that's a very effective strategy. I'll use Milwaukee as an example. Milwaukee the deal community is very oriented around attorneys, more so than most other cities. I grew up in St. Louis. In St. Louis, great companies trade hands all the time, and you never hear about it because investment bankers don't run that city, the attorneys and the accountants do. And they don't need to get their name in the paper the same way the investment bankers tend to want to. So we do spend a lot of time in that trusted business advisor class. It is in that third of deal flow. It's just not as regular. if you think about that investment banker who may see an opportunity once every 1, 2, 3 years that's right for us, there are a lot more attorneys and accountants out there, and they may see one once or twice in their career. So we're pretty selective about that, but we do spend time there. The other avenue that we look to is wealth managers. So if you're a wealth manager and you're working with a family that has the bulk of their net worth tied up in that business, boy, wouldn't it be great to get some liquidity on that, and now I'm managing a bigger portfolio. And so we do spend some time with wealth managers telling that story. And we have an investment opportunity that we're working right now that is just that. The wealth manager has been bothering his client for the last X number of years. Hey, all your money's in this business. Take a dividend. Let's diversify. Let's provide for future generations. And so he's finally listening to that message.
Interesting. Yes, Sean.
Why, yes, I'm glad you asked, Sean. Another loaded question from Mr. Ely. Yeah, we do. Yes, we've invested in a number of ESOPs, so it falls into that sponsorless bucket. So management-owned, family-owned, ESOP-owned. Yeah, absolutely. So my partner in New York, Lee Lewis, has a couple of decades worth of ESOP experience. He's kind of taken me under his wing, and now I've got a fair amount of ESOP experience. So it's a transaction style we like a lot. If you're familiar with ESOPs, many of them are structured upfront with a very large seller note. So we've both provided financing for the upfront ESOP purchase, as well as to refinance out that seller note 5 years, 6 years into the ESOP.
Within the context of a significant minority equity position, and I'll let you define what significant is, are there particular consent rights or control rights that you focus on in those types of situations?
Yeah, so regardless of whether it's a few percent or 40%, our rights in the document are going to be fairly similar. We're non-control. We're not going to have the right to control a board generally. A shareholder meeting, we're not going to have enough votes to pass anything at a shareholder meeting. What we do have is the rights that are spelled out in our document, and those are the kind of the key thou shalt not rights. Thou shalt not engage in affiliate transactions. Thou shalt not, if you're the CEO and also the owner, double your compensation without our approval. Can't do acquisitions without our approval. Can't take on significant additional debt without our approval. And so all of those rights exist in the document, but generally it's more of a conversation. Hopefully, before any of those come up, we've spent a fair bit of time interacting with that business owner and with that management team and helping them think about each of these strategic steps, and we're helping them with the process. So the formal act of coming to get our approval for an acquisition, well, chances are we helped you source that acquisition, we helped you do due diligence on that acquisition, we helped you finance it. So we do have those rights, and there are opportunities if the business plan changes, again, for us to raise our hand and say, you're great business owners, this just is not the risk profile we signed up for or the business model we signed up for.
So we have time for 2 more questions. I just want to ask Dan one that's on my mind and was part of the title of this program today, which is looking forward, say in the next year or two. While you get your sip of water.
Thank you.
What do you anticipate in terms of deal flow, in terms of pricing, and I guess you focus on North America overall in terms of the economy in Canada and the U.S.?
Yeah, so I'll take them in reverse order. So the economy, I was at a economic forecast luncheon about 2 months ago, and the economists at a poll of his esteemed colleagues, a third of them foresaw a recession in the next 12 months, a third of them saw growth in excess of 2.5% in the next 12 months, and the other third were in the middle. Some of them are going to be right. I don't know which ones. I can tell you amongst our portfolio companies, so we now have 9 portfolio companies, and the CEOs and CFOs and management teams are generally pretty optimistic. Seem to have made it through the tariff issue and what's going on with the NAFTA redo. A couple of industries certainly heavily impacted, farming being one of them, agriculture in general. But most of the industries we invest in have come through just fine. Unemployment at 3.7%, basically at full employment. If you look at the stratification of that, if you look at those holding a college degree, unemployment's 2.1%, I believe. I mean, the common complaint amongst our business owners is we can't find talent. If you're looking for an engineer, you're looking for a tool maker, you're looking for a skilled laborer, they're really, really difficult to find. Our same thing on the unskilled side. Our company that does carpet laying, we could grow 20% next year if we could just find the labor to install carpet. But the construction trades are still hot and heavy, and we just can't find the labor. So my forecast, my personal forecast, is that we're going to have a little bit more of the same. I think we're going to see growth this year and into 2020. I don't see anything that would necessarily cause a recession. We've obviously got the election coming up, and there is a huge difference between what some of the Democratic candidates are saying in terms of the economy and where they would take the economy versus the Republican side, as there always is, but it's probably a bigger gulf now than it has been in the past. And so I think the election will tell the story. In terms of private equity in general, one of my former colleagues, who Sean knows, is famous for the quote, "There's just too much of everything." And that is definitely true in the capital markets. There's just too much capital. And so you've seen the prices for companies, particularly good companies, just get bid up over time. And so you now have average multiples in the 10 to 12 times EBITDA range, whereas 10 or 15 years ago, they were in the 7 or 8 times range. And so it continues to be a very good time for sellers. If you look at the capital overhang, which is the amount of capital private equity firms and their financing partners have to invest, it's bigger than it's ever been. LPs continue to flood money into alternative assets. And so I don't foresee that changing. Private equity funds are still being structured the same way with a 5-year investment period, initial investment period. So there is motivation for these funds who are sitting on big pools of capital to get them invested. And so even if we do see a recession, and I do, the one area of the economy I do see an issue with is overlevered in in private equity owned private companies. There does seem to be an excess of leverage there, in my opinion. But I also don't see that changing in the next 12 months.
Good. 2 more questions. Let me go back to, do you have one?
Yeah, I do have a question.
Okay.
So, since you don't take controlling interest in the company.
We will very rarely take a controlling position.
Right.
Yeah.
I'm kidding.
Yep.
But like in all seriousness, does it allow you to be able to take interest in the same company that might have a competitor?
Yeah. Very good question, and that's the basis of why we're generalists. If we were focused on a given industry, we can make one investment, and then we start to run into competitors, and we won't do that. So we've done made a number of investments in building products, for example. Well, in building products, you can invest in a door and window company, you can invest in a company that does weather stripping, you can invest in a company that does wood floors. Those don't compete against each other, but they're broadly in the same industry, have a lot of the same characteristics and dynamics. So that we will do. What we won't do is, if we have an investment in a flooring company, we're not going to invest in another flooring company. And so many private equity firms have become very specialized in a given vertical. We're not able to do that because of our non-control nature. We don't effectuate the roll-up of an industry. We're the bystanders to it. And so we are cautious about not investing in competitors.
The last 2 questions, I want everybody to get out of here by 9. In the plaid shirt, then Pete.
I want to ask you, how have you or your companies been able to manage margins and pricing given the headwinds, like you even referenced on labor, freight, raw material costs, et cetera?
It varies by portfolio company. So I'll use the example of one of our companies that where wood, they make a company called Backyard Products. They make wood play sets and sheds, and so their main input is wood. And so last year, when the price of lumber spiked, they had to work with their customers, Home Depot and others, to pass those price increases through. You get pushback every time, but in that case, there's a quoted index that they can at least point to and say, all right, Home Depot, look, you know what we're facing. We need the price increase. And generally, they got it. And then lumber prices come back down, and you try and hold that margin as best you can, but eventually you give it back up. So you lose some on the front end as it goes up and hope to gain a little on the back end and even it out. On the tariffs, none of our companies have particularly had trouble passing those increases through. Again, everyone's aware of it. Where we do have more trouble is on the labor side. And many of our companies' customers just don't want to hear it. They're facing the same thing with their labor costs, and they just want us to become more efficient. And so some of our companies have seen some modest margin compression. We talk in our shop about how the healthiest thing for our portfolio, sad to say, but might be a recession in single-family housing. If single-family housing, which takes up so many workers at the lower ends, if that would slow down just a little bit, it would provide a lot of relief to a lot of our companies.
Last question, Pete.
If your minimum investment is $10 million for a non-controlled position, it would suggest to me that the enterprise value is probably north of 20, probably north of 25. My guess is your average is significantly higher than that. Where would one go if they had they liked the concept, but didn't meet your size requirements?
Yeah, so within our size range, there's actually a fairly limited pool of folks who do what we do. In that next step lower, in terms of dollar investment size, there's a group of companies, a group of investors called SBICs, Small Business Investment Companies, and they routinely do very similar things to what we do for companies with 1 to 7 million of EBITDA. We started at 8 million of EBITDA, and so if you want to come by afterwards, I can talk to you more about it. But that lower middle market has a fairly active group of SBICs that will make similar types of investments.
Okay, well, let's wrap it up here. Thank you, everybody, for coming. November 15th is our next meeting. Remember, our idea is to socialize and build our business networks and have fun and be educated. And finally, thanks to Dan Kessler for being here today. Thanks, Dan.
My pleasure. Thank you.